Let me begin with a simple but unsettling truth. If silver were to reach $10,000 an ounce, that price would not be the story. Prices never rise in isolation. They rise because something beneath the surface of an economic system has already fractured. So when people ask, what if silver hits 10,000? The more honest question is this: what must already be broken for that to happen? And the answer reveals far more about capitalism power and inequality than about silver itself. We are trained to see precious metals as investments, as charts on a screen, as speculative bets. But historically, silver has been something else entirely. It has been money. It has been trust. It has been a social agreement that value will not evaporate overnight. So if silver explodes to that level, what we are witnessing is not a boom, it is a confession. A confession that the system people were told to trust no longer works for them. The first thing that breaks confidence in paper money. The first thing that breaks is confidence in fiat currency. Money works only because people believe it will hold value tomorrow. The moment silver reaches such an extreme price, it means millions, perhaps billions, of people have decided that paper promises from governments and central banks are no longer credible. This is not caused by ignorance or panic. It is caused by experience. People have watched their wages stagnate while prices rise. They have watched savings lose purchasing power year after year. They have watched money printed in vast quantities, not to improve their lives, but to rescue financial institutions. At $10,000 silver, the illusion collapses. The promise that inflation is temporary, that monetary expansion is under control, simply no longer convinces. When trust dies, people flee not to speculation, but to what they believe cannot be printed, diluted, or manipulated overnight. That is the first rupture. The bond market and the debt illusion. The second thing that breaks is the bond market, which is the quiet backbone of modern capitalism. Governments survive by borrowing. Corporations expand by borrowing. Entire economies run on the assumption that debt will always be rolled over, refinanced, extended. But silver at that level signals that lenders no longer trust borrowers. It means the risk of default, inflation, or currency debasement is no longer theoretical, it is priced in. When bonds lose credibility, interest rates must rise to compensate for fear. And when interest rates rise sharply, debt becomes unpayable. Governments face impossible choices / social spending, raise taxes on populations already under strain, or print even more money and accelerate the very collapse they are trying to prevent. This is how debt, once marketed as manageable, reveals itself as systemic fragility. The banking system under stress. The third thing that breaks is the banking system's appearance of stability. Banks do not hold real wealth, they hold claims. They rely on confidence, leverage, and timing. If silver reaches such heights, it means people are moving out of financial assets and into tangible stores of value. Bank deposits shrink, liquidity tightens. Suddenly, the promise that your money is safe inside a financial institution becomes conditional. History teaches us this lesson repeatedly. Banks are strong until they are not. They function smoothly until fear enters the room. And when fear arrives, it spreads faster than any regulation can stop it. A $10,000 silver price would tell us that the public is no longer reassured by reassurances. The myth of a strong middle class. Another casualty is the myth of a stable and protected middle class. Inflation is not neutral. It does not affect everyone equally. Those who own real assets, property, commodities, businesses are shielded. Those who live on wages and savings are exposed. If silver explodes upward, it means the purchasing power of ordinary people has already been severely eroded. This is where economics becomes political. People begin to ask uncomfortable questions. Why did productivity rise while wages did not? Why were trillions created to stabilize markets, but not to stabilize households? Why are working people asked to be patient, while wealth concentrates at the top? Silver at $10,000 is not just a market signal. It is a social indictment, global power, and the dollar question. At that price, what also breaks is unquestioned faith in the global monetary order. The dominance of the U.S. dollar rests on trust, trade, and military power. But it also rests on the belief that holding dollars is safer than holding alternatives. When precious metals surge to extreme levels, it suggests that nations, not just individuals, are hedging against that dominance. Central banks accumulating gold and silver are not acting emotionally. They are acting strategically. They are preparing for a world where reliance on a single reserve currency becomes a liability rather than a benefit. This shift does not happen overnight, but a $10,000 silver price would tell us it is already well underway. The psychological breaking point. Perhaps the most important thing that breaks is psychological. People begin to see that the system is not designed for them. Once that realization spreads, compliance weakens. Trust in institutions erodes. Economic explanations no longer satisfy lived experience. And when belief collapses, systems that once seemed permanent suddenly become fragile. This is not about silver lovers being right. It is about society recognizing that endless growth, endless debt, and endless money creation were never sustainable. They were tolerated as long as they could be disguised. Extreme prices remove the disguise. A silver price of $10,000 an ounce would not be a story about metals or markets. It would be a public admission that trust in money itself has fractured. Money is not valuable because of paper, ink, or digital entries on a screen. It is valuable because people collectively believe that it will hold purchasing power over time. When that belief weakens, people do not debate theory, they change behavior. A surge in silver to such an extreme level would reflect millions of rational decisions made by individuals and institutions who no longer accept official assurances that their currency will protect their labor, savings, and future. For decades, central banks have insisted that inflation is manageable, predictable, and ultimately beneficial. Yet lived experience tells a different story. Wages have lagged behind productivity, savings have steadily lost real value, and the cost of essentials has risen faster than official statistics admit. When people see their money buy less each year while being told the system is stable, credibility erodes. The moment silver reaches an extraordinary price, it becomes impossible to dismiss that erosion as coincidence. It reveals a collective judgment that monetary authorities have overused their power to create money while under-delivering on economic security. The rise of silver would also reflect a deeper awareness that fiat currency is no longer anchored to real economic output. Money creation has become a substitute for structural reform. Instead of addressing inequality, underinvestment in public goods, or declining industrial capacity, policymakers have repeatedly relied on monetary expansion to stabilize markets. This approach may postpone crises, but it does not resolve them. Over time, people learn that newly created money flows upward into financial assets, inflating prices for stocks, real estate, and commodities, while everyday earners absorb the inflationary consequences without receiving the benefits. A silver price at $10,000 would therefore represent a mass rejection of monetary narratives. It would mean people no longer believe that central banks can print without consequence, or that deficits can expand indefinitely without social cost. When trust collapses, people do not wait for confirmation from experts. They act first and justify later. Silver, with its historical role as money and its tangible nature, becomes not a speculative gamble, but a vote of no confidence in promises that have repeatedly failed to materialize. There is also a psychological dimension that cannot be ignored. Trust, once broken, is extraordinarily difficult to restore. Each financial crisis, each bank rescue, each round of quantitative easing reinforces the perception that the system protects institutions before it protects households. When silver reaches extreme valuations, it reflects accumulated memory of bailouts, currency debasement, and policies that socialize losses while privatizing gains. This is not fear-driven behavior. It is learning based on historical evidence. The most dangerous aspect of monetary distrust is that it spreads silently. People may not articulate it in economic language, but their actions speak clearly. They hold fewer savings in cash. They seek alternatives that feel more secure. They disengage from long-term financial planning because the future feels unpredictable. A dramatic rise in silver would signal that this silent withdrawal has reached a critical mass, transforming private doubt into a visible market signal. At that point, official reassurances lose their power. Statements about inflation being under control no longer persuade those who have watched purchasing power erode year after year. Policy tools that once stabilized expectations become less effective because the underlying belief system has already shifted. Silver at $10,000 would not be creating the crisis, it would be revealing it. It would show that money, the foundation of every economic transaction, has lost the trust required to function smoothly within society. And when money loses trust, the consequences extend far beyond markets. Contracts become riskier, long-term investment slows, and social cohesion weakens. People begin to question not just economic policy, but the legitimacy of the institutions that design it. That is why such a price would matter. It would mark the moment when monetary authority, once taken for granted, is openly doubted by the very people it depends on to function. A silver price reaching $10,000 an ounce would immediately expose a reality that has been carefully managed and largely concealed for decades. The global debt system survives, not because it is sustainable, but because confidence has not yet fully collapsed. Modern economies are built on borrowing. Governments finance operations through debt, corporations expand through leverage, and households are encouraged to live on credit. This structure functions only as long as lenders believe debts will be repaid in currency that retains meaningful value. When silver rises to such an extreme level, it signals that this belief has fractured. Debt is often presented as manageable because interest rates have remained historically low. What is rarely emphasized is that low rates are not a natural market outcome. They are a policy necessity. Central banks suppress rates to prevent the debt load from becoming unpayable. A dramatic surge in silver would indicate that investors no longer trust this delicate balancing act. They would be pricing in a future where inflation, currency debasement, or outright default becomes unavoidable. At that point, debt stops being a growth tool and reveals itself as a systemic vulnerability. Once confidence in debt repayment weakens, the bond market becomes the first arena of stress. Bonds are promises that future income will be sufficient to honor today's borrowing. When those promises are doubted, investors demand higher yields to compensate for risk. Rising yields increase borrowing costs across the entire economy, placing immediate pressure on governments already running large deficits. The irony is that the very tools used to stabilize debt in the past, money creation and rate suppression, become less effective once trust erodes. A silver price at $10,000 would therefore imply that debt markets are no longer convinced by official narratives of fiscal responsibility. It would suggest that investors believe future repayment will occur in money worth significantly less than today's. In that environment, even technically solvent borrowers become suspect. Debt sustainability ceases to be a mathematical question and becomes a political one, forcing governments into choices that have long been postponed. These choices are all painful. Governments can cut spending, but doing so often targets social programs that support the majority of citizens, deepening inequality and social tension. They can raise taxes, but this risks slowing economic activity and provoking public backlash. Or they can print more money to cover obligations, which temporarily avoids default, but accelerates inflation and further undermines confidence. None of these options restore trust once it has been lost. They merely redistribute the costs. Corporate debt is equally exposed. Many large firms have relied on cheap borrowing not to invest in productivity, but to inflate share prices through buybacks and mergers. A surge in silver would imply that capital markets are reassessing these strategies. As borrowing costs rise, heavily leveraged companies face refinancing risk, layoffs, and insolvency. What was once framed as efficient financial management begins to look like fragility masked by easy money. The danger of a debt crisis revealed by silver is that it unfolds unevenly but spreads rapidly. Strong borrowers survive longer, while weaker ones fail first, creating a cascade of defaults and downgrades. Financial institutions holding this debt face losses, tightening credit further, and amplifying the slowdown. The system feeds on itself, not because of one bad decision, but because the structure was built on the assumption that confidence would always be there. At its core, a $10,000 silver price would tell us that the debt-based growth model has reached its psychological limit. Credit relies on belief in the future. When people no longer trust that future to deliver stable value, lending contracts, risk premiums rise, and debt transforms from an engine of expansion into a trigger for contraction. The market does not wait for official acknowledgement. It moves first, forcing societies to confront problems that were easier to ignore when confidence was intact. A silver price surging toward $10,000 an ounce would tear away the carefully maintained image of stability surrounding the modern banking system. Banks present themselves as secure guardians of wealth, yet in reality they are institutions built on confidence, leverage, and timing rather than stored value. They do not hold money in full, they create credit, recycle deposits, and rely on the assumption that not everyone will demand access at the same time. When silver reaches extreme valuations, it signals that this assumption is being quietly abandoned. The modern banking model functions smoothly only when people believe their deposits are safe, liquid, and redeemable at any moment. That belief allows banks to operate with minimal reserves while extending vast amounts of credit. A dramatic rise in silver would indicate that individuals and institutions are no longer comfortable leaving wealth entirely within the financial system. It reflects a behavioral shift away from trust-based assets toward tangible stores of value, and that shift places immediate stress on banking liquidity. Liquidity is the lifeblood of banks. Deposits fund loans, loans generate income, and income maintains confidence. When deposits begin to shrink, even gradually, the system tightens. Banks become more cautious, lending slows, and economic activity weakens. A $10,000 silver price would suggest that this process is already underway, not because of panic, but because of rational risk assessment. People move first when they sense instability, official explanations come later. The vulnerability of banks lies in their interconnectedness. One institution's weakness does not remain isolated. Balance sheets are linked through interbank lending, derivatives, and shared exposure to government and corporate debt. When confidence erodes, these connections amplify stress rather than absorb it. A surge in silver would be a signal that market participants are questioning whether banks truly have the assets they claim, or whether those assets can maintain value in an inflationary or currency debasing environment. Central banks often respond to banking stress by providing liquidity, lowering interest rates, or expanding balance sheets. These tools have worked in the past precisely because they restored confidence. But a silver price at extreme levels would suggest that confidence is no longer easily restored. Liquidity injections lose effectiveness when people interpret them not as reassurance, but as confirmation that the system is unstable. What once calmed markets now raises suspicion. Another overlooked weakness is asset quality. Banks hold large quantities of government bonds, mortgages, and corporate debt. These assets are considered safe largely because policy frameworks say they are. Yet if silver is surging, it implies a reassessment of what safe truly means. Inflation erodes the real value of fixed income assets. Rising interest rates reduce bond prices. Suddenly, balance sheets that appeared solid begin to look fragile, not because of mismanagement, but because underlying assumptions no longer hold. The most revealing aspect of such a moment is the gap between perception and reality. Banks can appear stable until they are not. Financial statements reflect past conditions, while trust is based on expectations of the future. A $10,000 silver price would tell us that expectations have shifted decisively. People are no longer evaluating banks based on reported capital ratios. They are evaluating them based on systemic risk and historical memory. History matters here. Banking crises do not begin with crowds at the door. They begin with quiet reallocations of wealth. They begin when depositors, investors, and institutions decide that exposure should be reduced, just in case. Silver's rise would reflect this silent calculation. It would be less about fear and more about prudence, less about speculation and more about survival within an uncertain system. What makes this especially dangerous is that banking stability depends on collective behavior. If enough people act on doubt, the doubt becomes reality. A silver price explosion would be the market's way of saying that this threshold is approaching. It would indicate that the banking system is no longer viewed as a neutral intermediary, but as a structure vulnerable to the same monetary forces undermining everything else. In that sense, silver would not be destabilizing banks. It would be revealing their dependence on belief rather than resilience. Once that belief weakens, no amount of technical language or regulatory reassurance can fully restore it. The system continues to function, but under strain, exposed in ways that were previously invisible to those who assumed stability was guaranteed. A silver price rising toward $10,000 an ounce would act like a spotlight on a reality that has been building quietly for years. Inflation does not impact society evenly, and it never has. It redistributes wealth, upward and outward, away from those who live on wages and fixed incomes, and toward those who own assets. Such a price would not create inequality, it would expose how deeply embedded it already is. The idea that inflation is a shared inconvenience collapses the moment essential purchasing power begins to vanish for large segments of the population. For working and middle-income households, money is primarily a tool for survival, not speculation. It pays for food, housing, healthcare, and education. When inflation accelerates, these households have limited defenses. Wages adjust slowly, savings earn little, and debt becomes more expensive in real terms. A dramatic surge in silver would signal that this group has already absorbed years of silent losses. It would indicate that people are no longer trying to grow wealth, they are trying to stop bleeding it. By contrast, those who own assets experience inflation very differently. Rising prices often lift real estate values, equities, and commodities, creating the appearance of prosperity. Asset holders are insulated not because they are more productive, but because the system channels new money toward financial markets first. A silver price at extreme levels would reflect this imbalance. It would show that protection from inflation is available, but only to those who already possess capital, reinforcing a divide that policy rhetoric frequently denies. The erosion of the middle class is the most dangerous consequence of this process. The middle class historically provides economic stability, social cohesion, and political legitimacy. When inflation steadily undermines its purchasing power, confidence in institutions weakens. People begin to feel that playing by the rules no longer leads to security. A $10,000 silver price would mark the moment when that realization becomes undeniable, when saving in cash feels irresponsible rather than prudent. What makes this dynamic especially corrosive is its invisibility. Inflation does not arrive with announcements or deadlines. It works gradually, shrinking opportunity while maintaining the illusion of normalcy. Paychecks still arrive, stores remain stocked, and markets continue to function. Yet behind this appearance, economic mobility declines. People work more hours for the same standard of living. Long-term planning becomes harder. Retirement feels increasingly out of reach. Silver's rise would be a visible expression of these invisible pressures. There is also a generational dimension that cannot be ignored. Younger workers enter an economy where asset prices are already inflated, wages lag behind costs, and debt is normalized as a requirement rather than a choice. For them, inflation is not an abstract concept. It is the reason homeownership feels impossible and savings feel pointless. A surge in silver would reflect a collective understanding that the system no longer offers upward mobility through labor alone. Policy responses often worsen the divide. Measures designed to stabilize markets frequently inflate asset values further while offering limited relief to households. Stimulus flows upward faster than it flows outward. A silver price explosion would indicate that these policies are no longer believed to be neutral or temporary. It would show that people recognize who benefits first and who pays last. Inequality becomes self-reinforcing in such an environment. Those with assets can hedge, diversify, and adapt. Those without assets are forced to consume inflation directly. Over time, trust erodes, not just in markets, but in the fairness of the economic system itself. Silver at $10,000 would be a warning that this erosion has reached a critical stage. At that point, the issue is no longer about metals or prices. It is about legitimacy. When large portions of society feel excluded from stability and protection, economic narratives lose credibility. The system may continue to operate, but it does so under strain, increasingly questioned by those who experience its failures daily. Silver would simply be the mirror reflecting a divide that can no longer be ignored. A silver price climbing toward $10,000 an ounce would send a powerful message far beyond commodity markets. It would signal that the existing global monetary hierarchy is being quietly questioned. For decades, the international financial system has revolved around a small number of dominant currencies, with one enjoying extraordinary privilege as the primary reserve, trade, and settlement medium. That dominance rests not only on economic strength, but on trust that the issuing nation will preserve value, honor obligations, and act predictably. When silver surges to extreme levels, it suggests that this trust is no longer taken for granted. Global monetary power has always been as much political as economic. Reserve currency status allows a nation to borrow cheaply, run persistent deficits, and export inflation abroad. Other countries accept this arrangement because the system appears stable and alternatives seem riskier. But stability is a perception, not a guarantee. A dramatic rise in silver would indicate that nations are reassessing this bargain, questioning whether holding large reserves in foreign currencies truly protects their economic sovereignty. Central banks do not behave emotionally. They move slowly, deliberately, and with long-term strategy in mind. When they accumulate precious metals, it is not speculation, it is insurance. A silver price explosion would reflect years of gradual repositioning, where countries quietly diversify reserves away from exclusive dependence on dominant currencies. This behavior signals a recognition that monetary policy decisions made in one country can have destabilizing consequences for many others, especially when money creation accelerates. The erosion of monetary hegemony does not begin with public declarations. It begins with hedging. Trade agreements start to bypass traditional settlement currencies. Bilateral exchanges rely more on local currencies. Alternative payment systems develop alongside existing ones. A $10,000 silver price would suggest that these shifts have reached a scale large enough to influence global markets. It would be evidence that confidence is fragmenting, even if official rhetoric insists on continuity. For developing and emerging economies, this shift is particularly significant. Many have experienced repeated cycles of currency crisis, capital flight, and inflation triggered by policy changes elsewhere. Holding reserves and assets that cannot be created at will becomes a defensive strategy. Silver's rise would reflect a shared memory of vulnerability, a lesson learned from decades of exposure to external monetary decisions beyond their control. Even among advanced economies, dependence on a single monetary center carries risk. High debt levels, political polarization, and unconventional monetary policies raise questions about long-term stability. A surge in silver would indicate that these concerns are no longer confined to academic debate. They are being priced into strategic decisions. Monetary diversification becomes not an act of defiance, but of prudence. What makes this process especially destabilizing is that monetary dominance relies on collective belief. The moment enough participants begin to prepare for alternatives, the dominance itself weakens. This is not because one currency suddenly fails, but because its unquestioned role fades. A silver price at extreme levels would be the market's way of signaling that this psychological shift is underway. The implications are profound. As monetary power becomes more distributed, coordination becomes harder. Exchange rate volatility increases. Trade relationships grow more complex. Institutions built around a single dominant currency face adaptation pressure. None of this happens overnight, but the signals emerge early. Silver's rise would be one such signal, reflecting a world moving cautiously toward a more fragmented, multipolar monetary order. In that environment, precious metals function as neutral ground. They are not issued by any government, influenced by any election, or altered by policy decisions. Their appeal lies precisely in their political indifference. A $10,000 silver price would reveal that this neutrality is being valued more highly than allegiance to any single monetary authority. The story, then, is not about abandoning one system for another overnight. It is about gradual erosion, about preparation rather than panic, about a global economy quietly adjusting to the possibility that monetary power, once centralized and unquestioned, may no longer command universal confidence. Silver would simply be the visible expression of that deeper transformation. A silver price surging toward $10,000 an ounce would ultimately point to something deeper than markets, currencies, or policy tools. It would reveal a breakdown in legitimacy. Economic systems endure not because they are perfect, but because people believe they are broadly fair, functional, and capable of improvement. Once that belief weakens, the system does not collapse immediately, but it begins to hollow out from within. Extreme silver prices would be a signal that this hollowing has reached a visible and dangerous stage. Legitimacy is the quiet foundation of every economic order. People accept wages, pay taxes, hold currency, and follow rules because they assume the system will, over time, reward effort and provide stability. When outcomes repeatedly contradict that assumption, faith erodes. A dramatic rise in silver would suggest that large segments of society no longer trust institutions to protect their economic future. This is not ideological rejection, it is experiential learning. People adjust beliefs based on what they live through, not what they are promised. For years, official explanations have insisted that instability is temporary, that inequality is manageable, and that growth will eventually lift all participants. Yet lived reality tells another story. Many work longer hours with diminishing security. Savings feel fragile. Long-term planning feels risky. When silver becomes a preferred store of value at extreme prices, it reflects a collective conclusion that the system's assurances no longer match its results. That gap between words and outcomes is where legitimacy begins to fail. What makes this moment particularly serious is that legitimacy does not depend on a single institution. It is systemic. Governments, central banks, corporations, and financial media all rely on shared narratives of stability and competence. When people stop believing those narratives, policy tools lose effectiveness. Interest rate adjustments, fiscal packages, and regulatory reforms no longer reassure, they are interpreted as signs of desperation. A silver price explosion would indicate that this interpretive shift has already occurred. There is also a moral dimension to legitimacy that economics often avoids discussing directly. People tolerate inequality when they believe it is tied to contribution, innovation, or effort. They reject it when it appears arbitrary, inherited, or engineered. A surge in silver would suggest that many now see the system as structurally biased, rewarding ownership over work and access over effort. Once that perception takes hold, compliance weakens. Rules feel negotiable. Participation feels conditional. The danger is not immediate revolt, but disengagement. People withdraw trust quietly before they withdraw consent openly. They reduce exposure, seek alternatives, and hedge against institutions rather than rely on them. Silver's rise would be evidence of this quiet disengagement becoming widespread. It would reflect a population that no longer expects protection from the system and is therefore building defenses outside it. Legitimacy crises also distort political behavior. When economic systems lose credibility, political explanations fill the vacuum. Blame replaces analysis. Polarization intensifies. Complex structural problems are reduced to simple narratives because trust in expertise has eroded. A $10,000 silver price would suggest that economic authority itself is being questioned, not just specific policies. Once that happens, restoring confidence becomes exponentially harder. History shows that systems rarely reform themselves under conditions of denial. They reform under pressure. A visible signal, like extreme precious metal prices, forces uncomfortable conversations that can no longer be postponed. It challenges the idea that everything is fundamentally sound and merely needs adjustment at the margins. It implies that foundational assumptions may be wrong. The most unsettling aspect of a legitimacy breakdown is that it does not announce itself formally. There is no declaration, no single event. It reveals itself through behavior, through what people choose to hold, avoid, and trust. Silver at $10,000 would be such a behavior, scaled to a level that can no longer be dismissed as fringe or irrational. At that point, the question facing societies is no longer technical. It is ethical and structural. Who is the system for? Who does it protect in moments of stress? And why should those who feel excluded continue to believe in its promises? Silver would not answer these questions, but it would make ignoring them impossible. So let me end where I began. If silver ever reaches $10,000 an ounce, do not ask how high it can go. Ask what failed first. Ask which promises were broken, which protections vanished, and which voices were ignored for too long. Because such a price would not represent wealth, it would represent warning. Economic systems do not collapse because of metals. They collapse because they stop serving the majority of people who depend on them. Silver would simply be the messenger. And history teaches us this: ignoring the message has never made the outcome better.